Hey, what is going on, guys? Welcome back to the YouTube channel. John Fibonacci here, and in this video is going to be part 6, the technical analysis. All right, we'll spend a little bit of time on the types of charts, and then we're going to dive right into the introduction to smart money concepts. All right, so if you're ready for that, let's get right into it. So what is technical analysis? It is the use of historical market data to predict future price movements, so on and so forth. Now, what I'm looking at for technical analysis is the charts, okay? Whether it be a bar chart, a line chart, I'm going to spend 99% of my time on what you see on the screen, which is the bar charts, okay? So I'm looking at technicals. What has the market done? And all that stuff. So I'm looking for the candlesticks predominantly as technical analysis. So some real quick and easy examples. Obviously, the candlestick chart. That's where I spend most of my time. It's probably where you are going to spend most of your time. And that's what it looks like. Now, every once in a while, I will take a look at a line chart. What's the difference? Well, the line chart on the default setting, it's not going to give you the same 4 pieces of information the way that a candlestick does, right? The candlesticks and the bar charts are going to give you the open, high, low, and close. So there's 4 pieces of information for every candlestick. A line chart, without messing with the settings, by default is going to give you just the closing price, and that's it. So it's moving from closing price to closing price. So it's not going to show you the fluctuations in every candlestick. There are times where this can be pretty important, but instead of switching over to a line chart, you could also just look at the bodies of the candlesticks as well. So it's up to you, but that's what a line chart looks like. And then the bar chart. So again, the bar chart and the candlestick chart, they display the same things, okay? Still open, high, low, close, but the difference is bar chart's a little bit old school. It's harder to look at, right? Because there's no bodies, there's no like thick candlesticks that we could look at up close, like green bars, or down close, red bars. We don't have that. So it's a little bit harder to look at. It's not as easy on the eyes, right? But it is available for you if that's what you want to look at. All right, so those are the 3 types of charts that I use: candlestick charts, line charts, and bar charts. Moving on. Oh, I guess not. I forgot I put this in here. All the candlestick charts and the bar charts, right? This is the type of information they're giving you. If we have an up close candle, for example, which is just by default green, we have an open, right? That's right here. We have the low, which is right here. The market traded higher during this specific time period. It made a high right here. And then it traded a little bit lower and then closed. So this could have been a 1-hour chart where, you know, this could have been 8 o'clock. This could have been 8:05, and then all the way to 8:50, it traded higher. And then maybe right at 8:59, it closed at 9 o'clock, like that. Okay. And this is going to be the same for every time frame, whether it's a 1 minute or a 1 hour or a daily. That's not going to change. Okay. Open, low, high, close. Down close candles, the high still going to be up here, the low still going to be down here. But if it's a down close candle, that means we opened up here and we closed lower than we opened. Okay. Now, the bodies don't have to be like this. You could have a close near the open, and that can still be a down close candle. Doesn't have to look like this. But again, every candlestick is going to give you 4 pieces of information: the open, low, high, close, or the open, high, low, close. And so here's kind of a brief example of that, of what I was saying a minute ago, how this could be a 1-hour candle and this could be a 1-minute chart. But see how it lines up? Like, this is your open, we trade lower, there's your low. And then we might trade higher for 20, 30 minutes. We might retrace, we might continue higher, retrace, continue higher. And then price retraces and then closes for that hour. And that's where the close is here. Okay, so this is a pretty cool depiction of especially like intraday trading, day trading, stuff like that. This is something that I would definitely take notes on. I mean, hopefully you've been taking notes this whole time instead of just waiting to download the PDF that I'll give you later. Hopefully you guys are taking notes, or at a minimum, at least a screenshot, I guess. But yeah, this right here is very, very important information. All right, understanding like higher time, because this could be a daily candle, and maybe this could be a 5-minute time frame, or maybe this could be a weekly candle, and this could be a 1-hour time frame. It just depends. But this is just an example of, you know, what this looks like as a candlestick, and what that candlestick looks like on a smaller time frame. All right. So which time frame do I use? You know, there's so many time frames to choose from. How do we know which one to use? Well, I don't want to say all of them. That's kind of a cop out, but there's a lot of them, right? And you could almost choose any one. But what I will tell you is that I would start from the higher time frames, like the weekly and the daily, and then move to the smaller time frames, everything intraday. So like 4-hour, 1 hour, 30-minute, 15-minute, 5-minute, 1 minute. Now I use these. Okay. I don't use a 30-minute. I don't use a 3-minute. I don't use a 2-hour or 4-hour or anything like that. These are the predominant ones I use: weekly, daily, 1 hour, 15, 5, and 1. You will fall victim to easy losses and even confusion if you neglect the higher time frames. Large entities trade large time frames. It's going to be like your banks, hedge funds, institutions. They may not necessarily be looking at like a 15-minute time frame, stuff like that. I do. But, you know, the big players, they might not be looking at a 1 minute, 5-minute. They're going to be taking trades based off of the weekly and daily time frame. And put this in your notes too. I didn't include this in here, but this is going to be important when we get to the market manipulation aspect of it, liquidity. I'll briefly tell you about that in this video, but large time frames, right? Large players on large time frames, that's going to be a area where we are going to target for either entries or exits for trade ideas. So that's why this is important. I'm not just giving you information just to give it to you. You know, this is going to be important later on in your development as a trader. All right. So this is called the top-down analysis, right? Where you work from the higher time frames down to the lower. So it's easy. Top-down analysis, W, weekly, D, daily, 1 hour, 15-minute, 5-minute, 1 minute. Okay. So I'll say this one more time because it's important. If you spend all of your time frame on the, or excuse me, if you spend all of your time on these smaller time frames, 5, 15, 1 minute, so on and so forth, 2 minute, and you neglect the weekly and daily, this is what's going to happen. You're going to get confused. You're going to take easy losses. You're not going to know what happened, and you're going to be frustrated. Okay. So on the weekend, especially weekly, daily charts, they take a long time to pan out. Markets aren't open on weekends, besides the crypto market, of course. But for stuff like Forex and futures and all that, you can use the weekend to do your analysis on the weekly and daily time frames. So do not neglect that. All right, moving on. In the introduction to smart money concepts, or SMC. Smart money controls the markets, okay? And you're going to get a lot more information either throughout the next few videos, or if you go through some of the other playlists that I have, you're going to get a lot more information on this. But again, this is the introduction, you know, to this if you've never heard of this before. Okay. Smart money controls the markets. Retail traders, which is you and I, do not move markets. Okay. We do not move markets. Okay. As much as people might tell you that, you might hear that on YouTube, or you might hear that from your uncle or a cousin or something like, oh yeah, you know, buyers and sellers and all that. I don't believe in that. Okay. I believe that we do not move markets at all. Okay. Who does? Who controls everything? It's the central banks, right? Remember in one of the previous videos, it might have been a terminology, and I highlighted to you that the smart money is the central banks, right? If you skip that video, I don't know why you did that. Don't do that. But we talked about, right, central banks being the smart money, right? They are the cream de la cream. They are the top of the top. There is nobody higher than central banks. Okay. There's nothing above them. They are literally the top of the pyramid, the top of the food chain. It's their house. Okay. They make the rules. You will notice algorithmic signatures in price delivery. Now it might sound weird at first, and that might not even make any sense to you. What do you mean algorithmic signatures and price delivery? John, what does that mean? That is so confusing. I don't even think that's worth writing down. It is worth writing down. Algorithmic signatures and price delivery. So on the smaller time frames, well, it's really all the time frames, but especially the smaller time frames, 1 minute, 5 minute, 15 minute, all the intraday stuff. Price is delivered. Okay, there's going to be buy side price delivery. That's like a bull market. There's going to be sell side price delivery where price is going to seek lower pricing. And that to me is what price delivery is. And price is delivered by a algorithm or algorithms, however you want to look at it. This is what I believe. And I prove it all the time, every week in the live streams. I call trades in advance and all that kind of stuff. And that's what it's based on, though. It is price delivery. And again, you will see algorithmic signatures, and we'll talk about that a little bit in this video as well. But mainly that's going to be on the live streams and stuff like that. So I do live stream 4 times a week. You guys can tune in. It's for free. And I get way more in depth with this, but definitely write that down as an introductory video. Okay. I'll take my camera off just so you can see the bottom real quick. Our job as traders is to align with the smart money or to align with price delivery. Okay. Because again, you and I don't move markets. The markets are delivered by an algorithm or algorithms, and our job is to align with that. If you go against smart money, if you go against price delivery, you will lose. Okay, it's as simple as that. You will lose. If you get in alignment with smart money, if you get in alignment with price delivery, you will take good trades. All right, and now an introduction to the imbalance. This is what a imbalance looks like. All right, where there's going to be 3 candles, and I did an arrow lower as this is like lower pricing. Okay. If we have lower pricing and it only takes 3 candles for this to form, an imbalance is going to be this candle's high right here, and then this candle's low. So there's space, right? Where basically we had sell side delivery, right? But we only had buy side price delivery that's somewhat efficient to the upside up to this particular price point. So between these 2 points here, that is an imbalance. So we can use that as, say, a target for the upside. And there's a lot of more factors that go into whether we're going to do that or not. Or if we expect lower pricing, an imbalance is something that we could short. Like we could short the market as it trades into this imbalance if we expect lower pricing. Okay, but very simple, very easy. That's what a imbalance looks like. And as with every other concept, every other idea, everything is inverted. So, you know, that's one on the downside. Here's price trading higher. Okay. And here's your imbalance from this candle. This candle's high, which is here. This candle's low, which is here. So that space between that candle's low and this candle's high is the imbalance. Where we saw buy side, right? We saw price deliver to the upside, and it only delivered to the sell side a little bit right here. Okay. And that's what makes that imbalance. Moving on to the mitigation. Here's an introduction into the mitigation. This is what that looks like. Now, there's a lot that goes into this. Okay. And if I haven't said this already, I need to. These drawings, they're just drawings, okay? They're ideas, they're depictions of what price action does. Now, it's not always going to be this clean because again, these are just drawings. I took, went into TradingView, I drew some lines, color coded them and made it look like how I wanted to make it look. But this is what price does. Now, you're going to see some lines here. The pink line on my chart is always going to represent liquidity. We'll get into that in this video too in a little bit. This low here, okay, when price makes a lower low and we trade, back above it and even through a previous high, this could be an indication of manipulation. More on that later. Okay. Or there might be something on a higher time frame down in here that if price is trading off of, I want to be aware of that too. So it could be something on the smaller time frame, it could be something on the higher time frame, ideally both. And once we trade through this high, price will come back into a up candle here or a series of up candles. Do not miss that. Okay? If you need to rewind the video or watch this video again, do it, or come back to it in a week and rewatch it, and you'll realize that you're going to miss things the first time around. And that's okay. I did too, especially with books. All right. Sometimes you got to watch a video 2 or 3 times or read a book 2 or 3 times. Don't be afraid to do that. But anyway, when price returns down and into an up candle or a series of up candles, there's going to be some other context and some other things here that we're looking for. But ultimately, if the market is bullish, I want to be longing in here. And that's what the mitigation looks like. Okay. And that's its function. Okay. That is, and there's tons of videos on mitigation, but that is the function of one of the functions of price delivery. Okay. If smart money is short and the market has now, shifted from bearish to bullish, that is its function. It is to allow smart money to exit their shorts before the market goes higher. And literally it's the function. So that's why it's called mitigation. I didn't create this. I didn't make this up. This is just how it is. All right. So obviously the inverse is going to be, I'll show you that. But in essence, it's a low, high, lower low, higher high. Okay. That's the mitigation for the bullish side. And the bearish side's the inverse. Okay. So the bearish mitigation is going to be a high, low, higher high, lower low, and then price returns into a down candle or a series of down candles with some other things up in here too that I just don't have on here because it's an introductory video, but this is what that looks like, where I can look for shorts for lower pricing. So if you've been trading for a while, or if you're familiar with like supply and demand and stuff, I believe all that's junk. And that might hurt your feelings, but that's honestly, that's what I believe. This might look like old support turn resistance, and you're not wrong in that idea, but this is a very specific, there's very specific criteria here. There's the reason that there's lines up here, and there's a reason that there's other context involved. That's why I'm telling you, so you don't just go in here thinking that every single high, low, higher high, lower low is going to be, shortable, because that's not the case. And if you go into price action, if you go in to the markets and look for this, you're going to see a lot of the times that just this formation by itself is going to get wrecked, and you're not going to understand why. And I just told you why. There's a lot that goes into this versus just a simple, high, low, higher, high, lower, low. There's a lot more to that. Okay. Moving on, a introduction to premium and discount. So this is very easy. When you have a range in price, okay, and you take a fib tool or a GAN box, that's what this is. If you have a high and a low, and price is coming off the low or is trading right near 50% or whatever, as long as you have a defined range, you have premium and discount levels. So from the low up to 50%, halfway point, that can be considered a discount. That's the lower 50% of the range. A premium market is going to be 50% up to the current high. That is a premium market. Okay. Now, this is very simple, very easy, but as with everything else, there's a lot more that goes into this. This by itself is pretty solid. If you are looking for longs, it's good to long in a discount. If you're looking for shorts, it's good to find shorts in a premium. But there's a little bit more to it than that. We can take it a little bit further. You can take 50% and you can divide that 50% in half as well. So now we have quarters, right? We have the lower 25% from 0 to 25%. We have from 25% to 50%. We have 50% to 75%, and then 75% up to 100. Okay, so we can divide the range in half, and then we can divide the range into fourths or into quarters. So now you have the discount end of the discount. That's where really good buying opportunities occur. Or you have the premium end of the premium, right? That's the upper 50% of the upper 50%. Okay. And a lot of good short positions will happen up here. Okay. All right. An introduction to liquidity. Equal highs and equal lows. All right. This is probably the most important part of the video, to be honest. I think it's all important, but if you had to tell me, or if I had to tell you, like, what is the most important, this is it. Okay. When I'm trading and I'm looking for market targets, okay, these are going to be them. What I'm looking for is equal highs. That is where you have two highs and they are the same. Okay. Or very, very, very close. But ideally, the closer they are together, the better. Okay. Some people refer to this as a double top, or the equal lows. They'll refer to this as a double bottom. It doesn't matter what you call it. None of the names matter, but what does matter is the context behind it. Okay. So equal highs and equal lows. I'm looking, if price is lower and we have equal highs, there's a good chance that I'm expecting for price to trade higher and above the equal highs. Vice versa. If we have a market that's trading way up here and we have equal lows, I'm expecting potentially that we might see lower pricing down to the equal lows. So I want to use these as targets. I want to target equal highs for the upside. I want to target equal lows for the downside. Now there's a little bit more to it. Okay. We also have high resistant highs where you have two highs, but you have the first high here and the high on the right is slightly higher or even like significantly higher. As long as it's higher, okay, that is high resistant highs. So if the market is trading lower, there's a good chance that this high here, the market's going to have a very hard time trading above that, unless there's something on the higher time frame. But in the short term, in the short run, like if this was a 1 minute chart and I might be bearish on the day, there's a good chance this could be the high of the day or the high of the session or something to that effect. And I might anticipate lower pricing. Now, the inverse of that, okay, where you have lows, the low on the left, right? And then you have the low on the right is lower and we trade higher. That is high resistant lows. Because a lot of the times this might signify manipulation, market manipulation. And if this is manipulation, the market usually will not go back down there another time. Now, there is times where it will. You'll see a low, you'll see a lower low, and you'll see a third lower low. That's not for this video, but you will see that eventually. But for now, these are pretty solid. And then we actually have one more. And again, I'll take my camera off so that way you can see the full image here. The opposite of high resistant highs is going to be low resistant highs. So what does that mean? Or what's the definition? You have a high right here, and the high to the right is lower or slightly lower. You see that? So there's a huge difference here. High resistant highs has a higher high. Low resistant highs, it has a lower high. All right, that's crucial. High resistant lows, where the lows, and there's a lower low. The inverse, where low resistant lows, you're going to have a low. And then the low to the right is slightly higher. Okay. Now, I know this might be a lot, especially if you're brand new, but trust me, the more you spend time with this, the more you study and back test and even like forward test, for example, like if you come hang out with us on the live streams and stuff, you will get a lot more familiar with this stuff. Okay. So definitely take some notes here or screenshots, but I would prefer you take notes. All right. So as far as liquidity goes as well, there is a lot more that goes into this, and there's a members only video on liquidity. All right. But you don't have to purchase a membership yet. I'm not here to sell you on that. Maybe down the road. Okay. But for now, there's going to be liquidity in the last, slide that I showed you. And then there's also going to be liquidity above previous day's high, at and above previous day's high, and at and below previous day's low. So what does that mean, liquidity? Well, liquidity is basically pending orders, okay? So there's going to be stop losses. There's going to be buy stops and sell stops. We've already been through that. If you haven't seen that video and you skipped it, you screwed up. You got to go back and watch it. Remember, we talked about buy stops, people buying the market as it goes up. There's going to be buy stops at the previous day's high. Or sell stops, where traders will put sell stops into the market thinking that it's going to go lower, right? And those sell stops, there's going to be sell stops at previous day's low and below it. Okay. So there you have it. I gave you some ideas here where there's going to be liquidity at low resistant highs and equal highs. And there's going to be liquidity at low resistant lows and equal lows. Okay. And as well as previous day's high, previous day's low. So I just gave you a bunch of things to go into your own charts and study. It does not matter what time frame you're looking at. It does not matter what asset you're looking at. You could look at oil, gold. You could look at index futures. You could look at crypto. You could look at the Forex market, euro, dollar index, British pound, whatever your favorite cross pair is, all that type of stuff. You will see these signatures. Okay. An introduction to the opening price logic. For this example, we're going to stick basically to a day trade. So let's say this is the New York Stock Exchange, meaning 9:30 a.m. Eastern. That is when the stock market opens. Opening bell, ding, ding, ding. Stock market's open. Okay, that's right here. Not on the chart, but just for depiction's sake, whatever price is at 8:30 Central, 9:30 a.m. Eastern, whatever price that opens up at, that's the session open. Okay. Now, just in this example, the market trades higher, then the market trades lower, right? The session open is important because what's going to happen is the ideal longs or buys, right? If you want to buy the market, if you want to long the market, the ideal longs are going to be below whatever that session opened at. Now, you can buy above the session open. Don't get me wrong. But the ideal scenario is going to be long or buys below the session open or close to it. And the inverse. Ideal shorts are above the session open. Okay. And that's what that looks like. Buying below the open if the conditions are bullish. I got videos on that. Shorting above the open if the market is bearish. Of course, I got videos on that too. And there you have it. All right. Well, I guess that's it. All right. So thank you guys so much for being here. Hopefully you guys got some value. If you did, drop a like on it. Make sure that you guys are subscribed as well. Like I said, somewhere throughout the video, don't be afraid to watch this again, a second time or even a third time. This is, some beginner stuff, but it kind of is advanced at the same time because it's a lot of information, right? The lows, the highs, the logic, the liquidity, this, that, and a third. This is roughly about a 30 to 35-minute video. So there's a lot that's packed into this. All right. And it's going to take time to understand. You really have to put in the work and get the experience. There's really no shortcuts. As much as I want to provide you with a shortcut to success, the learning curve is going to be the learning curve, and it can only be shortened so much. And that's it. All right. So again, drop a like, make sure you're subscribed, and I will see you in the next one.